So good afternoon and welcome to today's webinar. My name is Jason Kennywell. I'm an investment director here at VentureCrowd. So thank you very much for joining us. Today we'll be taking you through one of the most exciting venture capital opportunities in the country right now, which is the Aura Venture Fund number 3, which is actually being offered to you through the VentureCrowd platform from as little as $10,000. Interest in the fund has been extraordinary so far, and based on the current interest levels and the attendance and registration levels from this webinar today, we expect to close the limited $1 million tranche pretty quickly when we open publicly on Tuesday. Later in the webinar, we'll give you an opportunity to secure an application or to request more information. But for now, we just actually want you to sit back and relax. Today's webinar is designed to give you an opportunity to hear directly from the team behind the fund, and will be presented as more of a conversation with VentureCrowd CEO Steven Maarbani. If you have any questions during the presentation, please submit them via the Q&A bubble at the bottom of your screen, and we'll leave time for them at the end. We're also recording today's session, so if you do have to jump off early, we will send you the recording tomorrow. And if you'd like to share that with anybody that you think might be interested, you're welcome to do that. So let's get straight in. As I mentioned, today's webinar will be hosted by VentureCrowd CEO Steven Maarbani, who will explain the investment opportunity and fund details. As you may already know, Steve is a corporate lawyer and former PwC venture capital partner, specialising in funds management, and is responsible for the legal, compliance and asset management aspects of VC's fund investments. Steve also works directly with founders to help structure, launch and close their capital raising programs, and sits on the advisory board of a number of high growth private companies, working with their executive teams to help them execute their growth strategies. Today, Steve will be in conversation with Eric Chan, Mark Esterhuizen and Sabrina Zeng from Aura Ventures. This is one of the most experienced venture capital teams in the country today, and one of the top decile fund managers in Australia. That means returns from previous Aura funds rank in the top 10% globally. Eric Chan is the co-founder and managing director of Aura Group. Aura Group is a global financial services business specialising in funds management, wealth management and corporate advisory, with offices in Sydney, Melbourne, Singapore and also Bangkok. Mark Esterhuizen is one of the partners at Aura Ventures. He is a successful former entrepreneur who scaled and exited 2 of Australia's and APAC's fastest growing technology businesses. Sabrina Zeng is spearheading the corporate development at Aura Ventures, focusing on managing investor relations, fundraising, platform and network expansion. With that, I'll hand it over to you, Steve.
Thanks, Jace. I'm also just going to quickly forward you Sabrina's details. You might want to just give her a quick call and see if you can help her just get in. There we go. Okay. Thank you, everybody. Apologies for the slight delay. So, as Jason said, this is one of the most compelling venture capital opportunities in the market today. One of the most experienced teams in the business, with a track record in previous funds, which places them in the top 10% of venture capital fund manager returns, and a laser focus on investing in the next generation of outstanding Australian technology companies at the intersection of AI and enterprise software, the exact category that we believe is likely to produce some of the highest growth global exits in the next decade. We've partnered with the Aura Group to do something that's never been done before, to give everybody access to a top decile fund manager for as little as $10,000. Generally, Aura's minimum investment is $250,000. But we know that there is a huge amount of interest from a broad range of wholesale investors who want access to this type of investment strategy and this type of fund manager, but are not in a position to commit that kind of minimum. So we're thrilled that the concept of democratizing access to top end of town funds that have always been restricted to ultra high net worths and institutional investors is also an objective that the Aura team feel very strongly about, and we're really pleased to be partnering with them to make that possible. So for now, I'm going to bring in the people that you really came to hear from, and that's Eric, Mark, and Sabrina. So welcome, guys.
Hey, team.
How's everyone?
We got there. Sabrina's just been doing the dash from from one panel to another. Thank you.
Oh, I was getting close to taking this just like on the street in a tree somewhere. I just had to get on.
Don't worry, I've done it before. Hello and welcome to you. Hi, Mark. Hi, Eric.
Hey, Steve.
Hey, just before we get started, guys, can I ask you to maybe just a quick introduction about yourselves and your role in the fund, and then we'll just jump into some of the key things that I know are on people's minds.
Yep.
Yeah, sure. So I'm happy to start. So Eric Chan, I'm one of the partners, obviously, in Aura Ventures, but I was also one of the co-founders of Aura Group, which is a multi-asset asset management platform spread across venture capital, private equity, and alternative private credit. I, together with Mark and Sabrina and the team, we focus solely on venture capital while we've got different teams that does other strategies. And, you know, venture capital has been, I guess, the DNA of the group business. It's where we started. It's the first strategy we ran back in 2013, and it's still one of our, I guess, flagship and strongest strategies within the business.
Hey everyone, my name's Mark Esterhuizen. I'm one of the fellow partners with Eric. I joined the Aura ship just over 12 months ago. Background, I'm qualified chartered accountant. I've done everything from investment banking, run a hedge fund, scaled various businesses, both globally and in Australia, and more recently scaled two of Australia's fastest growing tech businesses. Joined the team after taking a short break from markets, after promising my wife I wouldn't build another business. But I thought, what better way to empower the next wave of innovation through steering founders with a lot more energy and without breaking my promise to my wife. So joined the venture team and looking to deploy our next fund across sort of 25 to 30 positions.
And my name's Sabrina. I don't know why my name tag actually had Mark's name on it, so I just edited that. I joined Aura about 2 years ago. I'm the corporate development manager, so my role is very cross-functional. I work very closely with the investment team, but also streamline a lot of the way that we operate across at the group level, with fund operations and our distribution and our marketing as well. And of course, get to spend a lot of time with our portfolio and prospective portfolio founders. Prior to joining Aura, I actually came across Aura when I was working in a different facet of the ecosystem in the innovation founder ecosystem. Their reputation and everything that they worked on really spoke for itself and really drew me to the team. And prior to that, I was working in corporate banking. So yeah, really wonderful to be part of the team and to be here with you all today. I'll throw back to you, Steve.
Thank you. And look, before we get into the actual fund itself, how it works, what its thesis is, I always think it's super important to understand the origin story of a team and their funds and what has come before them. So I might throw to Eric on this one. But Eric, would you mind just talking us through how Aura started? What is its origin story? What does it do today? What are the various parts of the business, fund size, international footprint, those kinds of aspects that will give an investor a bit of an idea of who's holding the reins of this particular fund?
Yeah, of course. So the business was co-founded by myself and my co-founder, Calvin, back in actually 2009. So we've been operating for 18 years now. When we first started the business, we both at the time, it was during the GFC, he exited a hedge fund and I was a transactional banking lawyer, which got extremely bored and decided to come out and do my own thing. When we came back together to set up a business, we had the ambition of actually going into venture capital investing. The problem was at that time was there was no venture capital market back in 2009. At the same time, we didn't have a brand, didn't have a track record. We were, two 20-odd-year-old kids that, probably looked 10 years younger than we were. So it was extremely difficult to build a business off. What we did have was strong skill sets around what a corporate advisory business would have through our prior careers. So basically, we started off the business as a corporate advisory business, advising early stage businesses. And I think from there, we helped actually build a lot of the backbone on how we actually add value to our portfolio companies in terms of how do we help them structure, plan their next capital rounds, but also how we actually plan and structure either a liquidity event for ourselves or for our founders. But around 2013 was when we set up our first fund, and it was a VC-focused fund. At that time, again, we started off the business doing deal by deal. So when you kind of look at our fund zero, or what we categorize as our fund zero, was actually a collective of deal by deal investments. We quickly discovered that it was much more beneficial to run portfolios within this asset class. And so in 2017, we did our first blind pool fund, which is our first vintage of 2017. And then we did our follow-on vintage in 2022. But as we were growing the business, one thing that we identified in the Australian market, because it was so nascent, was we just didn't believe the market was deep enough for you to be able to deploy hundreds of millions of dollars into this asset class as a single fund, especially when we were focused in a single stage. So while we wanted to maintain that discipline and philosophy in the way we invested in venture capital, we knew that in order to create a sustainable business, we had to do something more. So which is why we diversified into other asset classes. But we were strong believers that you need to build your strength and expertise within a specific skill set and particular type of strategy. And therefore, we didn't believe in actually running those other investment strategies ourselves. So we brought people into the business to run those strategies. So which is why while we're multi-asset as a group business, every strategy is run by a completely separate business unit that's fully dedicated and focused on that strategy. And so since then, we've grown the business across Southeast Asia, where we managed just over 1.4 billion across private equity, venture capital, and private credit. And we're a team of 66 people with a very strong, I guess, middle and back office infrastructure that supports the investment teams across these strategies. So we're kind of unique in the sense compared to a lot of VC funds in Australia, where we kind of have this VC mindset and VC strategy, but actually supported by a very, I guess, enterprise and much more sophisticated infrastructure behind us that a lot of the more newer fund managers don't have within the VC space.
Yeah, no, I think that infrastructure, when people think about some of the small funds in the market, it's very difficult to build the level of human resource infrastructure in particular of 2% of a $10 million or $20 million fund. So I think one thing perhaps investors might look over, but is a pretty important characteristic of the Aura group in particular, is the depth of that infrastructure, which is typically not available to a lot of smaller funds. So the business is now in a number of different areas. Private credit is one, wealth is another. But in venture specifically, there's 3 funds that have come before, right? This is technically Fund 4, isn't it? Even though it's Aura Ventures Fund 3. Can you talk us through the returns from those funds? And I know you're a humble team, but the fact of the matter is returns from those funds now place Aura as a top decile fund manager, so in the top 10% of returns in the category. Can you tell people about that? What does that mean, and why does that matter to investors?
Yeah, sure. So we, as I was mentioning, Fund 0 was our collective of SPVs. Fund 1 was our 2017 vintage, and Fund 2 was our 2022 vintage. And we're kind of going into, call it whether you want to call it Fund 3 or Fund 4, right? We were still deploying, or we just finished deploying out of our 2022 vintage in 2025. So if I separate that and just talk about Fund 0 and Fund 1, both have averaged circa around 3 times multiple in invested capital. But I think what's really, I guess, what we're really proud of is the fact that across all our funds to date, we've actually distributed back to investors about 85% of the deployed capital, right? All Fund Zero is fully deployed and exited. We've started exiting out of Fund One. And actually, as of this month, we've actually just made our first distribution out of Fund 2022 as well. And it is, if you just zoom in on our 2022 vintage, that is currently in top decile based on DPI on its own, meaning that we've returned more capital within that fund than any other fund manager within that vintage. And then on the TVPI basis, which is the total net return basis, we're also top quartile from that perspective as well.
Congratulations. That's a big deal. When we speak to many of the wealth advisory groups, they will say that fund manager selection is the first thing that they do. So I think for self-directed investors looking at this particular fund, that kind of track record certainly matters. Let's go to the fund itself now. There's a number of things happening in the market that are creating an opportune time to build a strategy in venture. Do you want to tell us about the thesis for this specific fund? What is it in particular that you're excited about, and where do you think the key drivers are for technology that make this a good time?
Yeah, I'm happy to start and guys jump in so people are not just hearing from me. So one thing that we're identifying today is that there is a true inflection opportunity where you've got this convergence of a market reset that happened a few years ago, which have brought valuation back to, I guess, from our perspective, much more reasonable basis. And then this new AI platform technology shift that's happening. And it's happening at the beginning of, and we're at the beginning of that cycle. And why that's interesting to us is because for a long time, we haven't seen an opportunity that's come about as this AI platform shift since probably cloud and SaaS, right? And if you kind of look back in SaaS, kind of call it 10 years ago when it first started, you kind of had this moment of disbelief where people didn't actually really understand the importance of the value of the recurring revenue nature of these businesses and their ability to generate network effects. And what you saw was at the beginning, valuations were relatively flat because adoption wasn't really occurring. Until people realized that these were not just, I guess, businesses, they were actually compounding machines that were able to generate alpha within their revenue base by creating this strong recurring revenue business that had the ability to actually create, I guess, really strong compounding growth without actually increasing cost base. And as people kind of came to the realization and adopted, and these business models were adopted, you started seeing valuations kind of re-rate, right? Where we believe we are at with AI is actually at that beginning part of the cycle where a lot of the B2B, especially in the B2B space, AI hasn't been re-rated. And we're seeing at the front line that actually some of the best companies are probably getting built over the last couple of years, or it's going to be built in the next 2 to 3 years. And you're still going to be able to come in and capture that early cycle valuations and getting at a good valuation point. Because the reality was, if you truly believe that AI is going to change the game in every industry, or it's going to change the way it's going to have a material economic impact, in order for you to get exposure in this space at the moment, it's actually really only in private markets. You could probably get access via when OpenAI lists or when Anthropic lists, but anything that you can get access to at the moment, it will probably mean that a lot of the value is already priced in. right? So if you want to be at the beginning of cycle and getting the, I guess, the asymmetric returns from these investments, the only real way you can get access to that at the moment is probably through private markets, especially in the early stages of the investment cycles in these businesses. The other thing that we're finding really interesting is, one of the issues in Australia, if I kind of look at it honestly, is Australia was already always operated in a very disadvantaged position compared to everyone else around the world. Like, we're far from everyone, we have much less capital than everyone, and like, frankly, like most people didn't really care about startups that came out of Australia when I first started, when I was first involved in these industries over a decade ago. But what's changed is there's a lot more attention and focus around Australia, because Australia has this unique DNA where our founders have this unique DNA of being super capital efficient. And AI has just improved that capital efficiency, which allows them to compete with other people, everyone else around the world. And but call it maybe 2, 3 years ago when the market reset, what it did was, investors around the world also realize that actually, no, it's not just about investing in growth and aggressive growth at all costs. Actually, businesses, you want to invest in the business that are capital efficient. And at that time, when they were looking around, they couldn't see that, I guess, those opportunities within their local markets. But then they started recognizing that these businesses out of Australia were actually quite capital efficient. And to give you some statistics as an example, we've created more unicorn businesses out of Australia per dollar invested than any other country in the world, right? And that's because of this capital efficiency component, or characteristics of the startups in Australia. But what that kind of meant was that it drew a lot more attention to Australian startups, and obviously the likes of the successes of Canva and Atlassian and Airwallex, etc., added to that. But that focus in Australia meant that more capital are interested to invest into Australia. Now, for us, we treat that capital as a positive as opposed to competitive threat, because what happens is, a lot of this capital coming in are wanting to come in a slightly later stage. But for us, so what happens is we often will invest into these businesses in its early stages, and then we will then help our portfolio companies actually tap capital offshore, which there's a lot more appetite for at the moment. And that allows us to help the portfolio companies not only to improve their probability of success when they expand into new markets, especially into the US, but also tap capital into those markets, which provides a much better valuation uplift as well. So one of the things that we've identified in this space, in today's market, is there's this valuation arbitrage that you can really achieve by investing at Australian valuations, and then as they kind of raise capital offshore, valuations re-rate to much higher multiples.
And if I can also touch on, I know your point around the macro environment is such a topical kind of part of the conversation that we've been having. And I think a big part of it is the reset that Eric spoke about, which can feel very uncomfortable in the short term, and is a conversation we've been having with a lot of our investors and founders as well, understanding what's the impact to the business, what is the impact to our investment portfolio. And the message that we keep reiterating and pointing to history as evidence of is that the resets are really uncomfortable in the short term, but they're always the foundation for strong long-term returns when we look back at the kind of historical performance of the markets. And so when we look at how valuations have compressed from the 2021, 2022 peaks, capital becoming more selective, growth at all cost mentality is kind of fading out. What that brings is better entry-level pricing, less speculative capital, and stronger governance as well that we're starting to see around the innovation ecosystem, and founders then building with a lot more capital efficiency. So the asymmetry that we're really going to capture with Fund 3 is capital becoming more disciplined while the innovation continues to grow and the platforms for technology and new categories continue to expand. And that's a very unique moment or window that we happen to be now able to raise our fund within. And that's a big part of where we see timing is so critical when it comes to venture and what we're capable of doing.
Yeah, thanks, Sabrina. Mark, I might throw to you on this because I feel like this is one of the key issues that investors want to want to talk about. Why do you think now is the right time, and what excites you about the opportunity for the fund in this particular environment?
I think I'll answer that in two parts, one from investor lens and one from probably us as the manager. I'll start with the manager components. To the exact points that Eric and Sam have raised already, is that you've got this sort of like unique entry window in terms of this catalytic shift from a technology standpoint. But I think also, obviously, there'll be new entrants, and the question around defensibility and IP and moat of a business will always come into question. Specifically, you can see what's happening with Claude and Anthropic and how they're going after different verticals. But what that really shines a light on is for founders that are building through the advent of AI and the introduction of AI, they're either AI native or AI enabled. Where you've got AI enablement for existing businesses, what it's doing is unlocking existing TAM that always existed but was never pragmatically or feasibly able to be sort of taken advantage of. So now, through the advent of AI, existing businesses are able to be established in around existing workflows or orchestrations to then tackle and task around solving their problem sets. And AI has now made it a lot more feasible and scalable in approaching that problem. So you've got a double whammy effect of new business ideas being shaped, but also existing incumbent businesses that have had problem sets that haven't been able to address, but through the advent of AI, they're able to do that. And then from an investor lens, if you think of like the different periods of investment windows and entry points, you've had probably in the last 50 years, three major events. So around GFC, the introduction of the internet around early 2000s, and then more recently with the advent of AI. AI is probably not a new concept. It's probably been around for probably over a decade, and more recently, probably in the last 3 years specifically, the scale of which it was being adopted and the types of applications that we're seeing coming out of the US specifically. But what's happened is that the stack of the AI, or when we refer to the AI stack, what we're referring to is the data, then the models that sit on top of that data, the APIs that create connectivity between applications and the model builders, and then the applications that get built on top of it. So if you dial the clock back 10 years, 5 years ago, you were primarily working with the data and intelligence layer, like the connective tissue, the brain frameworking. And now, as we've accelerated, the compute layers enable the model builders to accelerate the interest in market. And through that overall enablement factor, you've now seen the API layer and the application layer firing up. So from an investor, it's pause and measure in the early years is bearing fruit, because the assessments and sort of selection criteria of what type of business we invest on is rewarding a patient investor rather than a thematic or seasonal investor.
Yep. And there's no doubt that the impact of AI across some of these use cases, some of the things we're seeing in particular, are very exciting. There'll be a lot of choice for fund managers. How do you go about identifying the winners? I know it's the world's hardest question, and everybody has a different view about this, but maybe we could just run around this team and just talk about that for a minute. How do you identify who you think is going to be the winners? What do you look for? And also, what are the red flags that you like to avoid when considering an opportunity?
Cool. I think there's, I'll say the sort of three parts, the fund's thematic, our thesis, and then I guess my personal slant on that. So at the end of the day, we found a lead and thesis. We're driven by their thesis and deep insights around the problem. So ultimately, we the jet fuel and the enablement factor that allow a founder or founding team to pursue the problem sets. But it's because of their conviction in the problem or the angle at which they are trying to achieve in tackling that problem is where we get really excited about a founder or founding team. So it's a unique insight that they hold around the problem and how they're looking to address it. For when we're assessing a founder or founding team, we've got to ensure that they can wake up on the good days and the bad. Like when you've got a tailwind, it's pretty easy, puffy chest, and to explore a problem. But when the winds turn and you're sailing directly into a headwind, that's when you're really testing the grit and the makeup and DNA of a founder. And for me personally, when I look at a team, we're living in a world of like high technical enablement and capability. But because of that, there's a lot of window washing of wrappers and people portraying to be building really scalable businesses, but in essence, they're built on top of other models or other non-proprietary data or non-proprietary modes. So our assessment at the technical layer is no different to when you're investing in any other traditional business. It has to stand up on its own 2 feet. It has to have really good application states and way it tackles the opportunity. And it also goes to this idea that venture is risk on or more risky. If I had to say a panel beater that is growing at 30% month on month and highly cash generative, but it's only less than 1 year old, would you still paint the same paint, would have the same paintbrush to that business because it's early in nature or it's young in nature? I think what AI is able, or what it will bring to the party, is for the scaling time frame of which businesses need to scale to sizable businesses, it's going to shorten, and because of that, I believe fund life is going to shorten. But I don't think the market will fully reward or fully appreciate that a young business is not necessarily a risky business, and the ability for a manager or someone like ourselves to assess that business by opening up the hood and understanding what's underneath the bonnet and what the founding team has collectively in addressing that problem is like front and center. And then for me specifically, I work by like a DFI principle, decade at the top, fun in the middle, and integrity at the bottom. So I've got a no decade policies, and I think Eric and Sab have a similar view that it can be the best idea, but at the end of the day, we're true capital funding partners. So it's almost like a marriage or a relationship. We've got to be, there needs to be ticks across all of the scorecard. Fun in the middle, everyone needs to have fun along the way. Building a business isn't easy. There's going to be lots of twists and turns. So making sure that you can actually see the fun side of that equation, and sometimes not take yourself too seriously, is pretty important. And then integrity at the bottom of that acronym is because you need an integrity barometer or an integral bone in your makeup, because in the good and the bad decisions, you need to make sure that we as an investor land on the right side of that coin toss, and we're beholden to the founder and founding team to make the right decisions at the right time, because that decision wheel isn't going to slow down. It's only going to increase with the advent of AI.
I'll go.
I'm going to go first. You go first.
I saw your mute come up as well. Yeah, to sort of dovetail off of that, I think that as investors, we're kind of constantly dancing in between and context switching between like the long view and the short view. We've got to be able to kind of keep up with the velocity of founder land, the technology, sort of the landscape that we're working in can be very, very fast paced, and that's very high velocity. And then at the same time, we're also very, very consistently thinking about longevity and durability with our relationships, our portfolio, and being very high conviction and thesis led. If you think about, we've been in market 13, 14 years, 26 active companies, it gives you a good idea of kind of, the pace at which we deploy capital and the kind of depth to which we go into our due diligence process, which doesn't mean we only meet 26 companies in a year. It means that we're meeting, 4, 5, 6 times that, and actually going through the motions to make sure that we're distilling it down to the right people who we want to actually work with for the next decade. And kind of vetting for that and conducting that due diligence takes a lot of time and a lot of commitment, and making sure that, from the technical layer, that the capability is there, from the founder perspective, that's also there. I think that one thing that often is over-indexed on by founders is actually sort of the technical capabilities of their product, and they kind of under-index on their ability to actually show us that they are the right person to solve that problem, and that they have an obsession with that space and with that industry, and that they are going to be the right person to solve that problem, not just today, but also in 5 years and then also in 10 years. And that story and that ability to be able to convey that, I think is at times more important than one specific feature or sign this NDA before we get a look at your product. That's kind kind of missing the point a little bit. I think that it's really easy in this industry to confuse noise with defensibility and get really caught up in the hype cycles. So we spend a lot of time as well making sure that we understand the technical component to the extent that we need to conduct really strong due diligence across the portfolio. Because at the end of the day, we're not building the actual products, but the role that we want to play in partnering with these companies long term means that we need to still be able to provide value and understand it to the extent that we need to, and then make sure that that's the right person who has also built the right coalition of people around them to be in it for the long term. So I think it's a really interesting one. It's very relationship based when we sort of think about founders. I think the technology, even our conversation around AI right now, doesn't really matter that much. This could be a different conversation in 10 years. We could be talking about some new infrastructure layer that changes compresses the cost of building a company again, but the principles around who they are and the context and why them and their right to win will always be the fundamental kind of tenet of how we assess the opportunity. Throw to you, Eric.
Yeah, look, I think the guys covered it really well, but essentially, for us, especially during a period where there's just so much noise in the market, like the easiest thing for us to do, and which was what we always done, is actually go back first principles. And the guys touched on it in the first principle is like, it's never about the technology. Well, most of the times it's not about the technology, right? Especially in an era where actually we don't believe that there's technological moat most of the times. You're seeing businesses that are vibe coding to their MVP within days. Like, where's the technological moat around that?
Yeah.
So it really is around the problem or the thesis around the problem that they have. Like, at the end of the day, if you're not solving a real problem that customers care about, and you're doing it in a way that's meaningful enough that they're willing to pay money for it eventually, then you're not really building a business, you're just building a hobby, right? So start from problem, then is founders. And for us, maybe just to extend what the guys have already said, it's not just about picking the winners, it's also about working with the founders thereafter and actually understanding how these businesses grow from a pre-seed business and how they actually mature and how they should mature. It's actually helping them avoid traps or actually providing them the wrong advice, right? Which sometimes investors that don't understand this stage actually do, which is, I give you a perfect example where, people are embedded in their mind, and rightly so in some sense, but maybe not in the stage that we invest in. It's always thinking about how do you monetize, how do you generate revenue, etc. But the fact is, when you're at the early stages, most of the times is you don't actually really know whether your product solves the problem for a customer in the way that they need it from day one. You might have a thesis around it, but you don't know. So if you don't know whether you've got the right product and you just go off and try to push your go-to-market and try to sell product, then 9 times out of 10, you're probably going to fail. You're going to waste a whole lot of marketing dollars trying to get to that stage. What you really should be focusing on a lot of the times is actually just focusing on your product, understanding who your ideal customer profile is, understanding whether you're solving the problem, rather than actually doubling down on actually go-to-market spend. And often we would see investors actually pushing founders to the latter direction purely because they want to see revenue hit the door, because that is the validation. But the way that we've learned to look at these businesses, validation points is not necessarily always revenue. Most of the times it's not revenue in pre-seed, it's other metrics, especially around product love, around engagement of the product, et cetera, et cetera. And so the way that we work with the customers, actually guide them at the beginning, is extremely important. And I guess like maybe outside of picking the winners is also avoiding traps, right? The fact that we've been doing this for over 13, 14 years, one of the benefits is we've had the benefit of time of actually, I guess, enriching our data and feedback loop on actually how to invest as an investor, right? Like avoiding certain traps on actually what you shouldn't bet on where it looks maybe attractive. Like as an example, you should try to avoid investing purely based on a really attractive deal terms, because deal terms don't build winners, right? Deal terms just makes the investment more attractive, but it shouldn't be the fundamental thing on why you actually make that investment when you're thinking about when you're thinking about venture capital investing. It's a lot of these traps that we've learned over the years, and in fact, some through mistakes of our own, that actually compounds that value that we provide in actually building our portfolio and making our investments.
I love that. And one of the threads that runs through all of your answers and conversations we've all had separately before is this idea of picking the founder who can get up and do it every single day, even when it's hard, right? Because everybody enjoys the honeymoon, but what happens when it gets tough? What happens when a product thesis hits a wall with a customer? What happens when you need to pivot? What happens when you get pushback on pricing, right? Where you were convinced it was worth every cent. How do you screen for resilience?
Yeah, look, a lot of it has to do with actually our interactions with founders, and ideally, like the longer we spend with a founder, the more you're going to get insights around them, right? And a lot of the things that we see within great founders or similarities is it is that deep, unique insight into the problem that they have, but also the obsession they have with that problem, which Sab mentioned. And when you're obsessing about the customer and the problem, you naturally can identify that the founder is actually not just trying to build a business based on an idea, they're actually trying to solve a problem. And as they're trying to solve that problem, everything will just fall in place. Now, you also kind of pick certain characteristics of founders in terms of the way that they act, they interact with us, and how they think, right? But one thing that we also try to do is actually just pick out how many layers deep does this person actually have around the problem that they're solving, and how they kind of think about it. So, maybe you scratch the first couple of layers and they have great questions, but the more you deep and sometimes what we're looking for is actually, do they have good responses for them? Or maybe they don't actually have great responses for them, but they go away, and then by the time we have the next meeting, they come back and go, hey, that question that you asked me, forget what I just said. I kind of thought about it, looked into it, and this is what I think it is, and this is my thesis, right? It's those kind of like interactions that would help us build confidence and conviction within the founder. And you mentioned pivot before, and the reality is, from what we see, we believe most businesses will end up pivoting one way or another, right? Because everyone has a thesis, but no one has the perfect answer from day one. And when you kind of distill it, like you're generally pivoting in over four things, which is either product, the way you position your solution, the problem that you're solving, and the personas that you end up selling to, right? And if ideally what you need to do as a result is if you kind of go into this knowing that eventually these founders need to pivot at least one or more of those things, then you need to actually build confidence in the founder's ability to be flexible, to have like that ability to learn and that ability to like not just be so stubborn about a particular way of doing things, and be flexible to actually pivot in the way that they actually adjust to actually what the customer actually is looking for, as opposed to just what they think it is.
Yeah. So let's play that out just a little bit longer, and then we'll move on to a different topic. But I think one of the most interesting things about the Aura Group is how you started, right? Which is advising individual companies on growth strategy and capital raising. It's that period of being in the shoes of the founder, actually in the trenches, building businesses through those hard things. How do you apply that now to helping portfolio companies grow? So how do you engage with portfolio companies along the way to see where they're at, to see what challenges that they're facing, to then assist them with those challenges, and then obviously international growth? But before you get to international growth, which is your Asian and US footprint, how do you help them to solve challenges before that point?
Yeah, I think going back to the assessment on a pre-investment basis, there's the assessment of grit and call it muscle makeup. how I assess curiosity, which basically informs the way that generally a person addresses problem solving, is I sort of take them far left, far right in the conversation to go, well, like, how many times have you changed a tap at home? Like, have you ever explored around with your plumbing? Like, have you ever changed a geyser? Have you ever, like, things that are outside of their wheelhouse, like how curious are they around problem solving and how curious are they to learn? For me, it provides a lot of insights. I think a lot of what we do is psychology based, because we are backing an early stage, an idea, an early stage business. We've got to assess the psychology and how the sort of the makeup of an individual can navigate both the EQ side and the IQ side of building a business. So testing against sort of family dynamics, background, sort of key learnings, just sort of broader insights, broader awareness of global matters. So that for me is an assessment up front. And then as you step through any type of thinking style or go-to-market strategy, we often act as the mirror in front of that founder. So we're almost playing back the questions put to us, but directing them to frame their thinking. Like, more often not, founders, the better founders surround themselves by really good people around them, and they don't proclaim to own or know all subject matter, and they're willing to take on advice and willing to use the best of breed around them to form those views. I think a lot of the time startups move at pace and speed with the view that that's sometimes better. But as we move into a more globally connected world, entering the right market at the right time is better than just entering a new market to tick a box for potentially venture capital or a new investor. To unwind a decision that involves heavy capex or opex by an expansion plan can sometimes not only set you back in dollars and cents, but specifically in time. However, to simplify that message to founders, I always sort of say, think of decisions as one-way doors or two-way doors. Like, one-way doors, really hard to come back through the door, and it's going to be either break down the door, build around it, go over it. Two-way doors is like, make the decision. If it doesn't really work, go back the other way and start again. So try avoid the one-way doors. The two-way doors, don't be scared, move at pace, learn, iterate, move on. But like anything, you learn through doing. So put your hand on the stove, burn your hand. You're not going to put your hand back on the stove again.
Do you want to add anything to that? You don't need to, I can move on, but I just want to give you some space in case you wanted to talk about that.
In case we all jump off mute, I'll just add like a little bit to the end of Mark's note. I think one thing that, in terms of a pattern that you kind of see in really strong founders as well, that translates into how we end up working alongside them, is for founders to have conviction in the places where they need it, and then also self-awareness in the spaces where they need it. So I think coming to us and kind of initiating those relationships and having conviction around the insight into the problem and understanding what the future of that industry should look like, you know, with whatever they're building. On the flip side of that, if founders have really good self-awareness of their own blind spots and where they require support and where the gaps are and how they're going to build that out in the role that we sort of play within that, that has kind of been really conducive to, I think, some of the best working founder relationships. I think Mark and Eric both, you know, prime examples of investors who know what it means to build and know what it means to be a founder. And a lot of the kind of challenges you see where they really come through is, especially if they're supporting sort of first-time founders, you know, the first time, excuse my French, shit hits the fan, and these two just being calm as anything and knowing exactly kind of what to do because it's run of the mill and it's kind of like running a business is all part of the journey. So I think that experience, that time in market, like, you cannot underestimate how valuable that actually is to have been in the shoes of a founder and a builder. And I think that's a big part of the Aura brand in terms of the VC arm and actually what we bring, because I wouldn't say that's necessarily consistent across all VCs in terms of the background that they come from, but I think that's a big part of our DNA. And to have that kind of perspective, that like scrappy founder perspective combined with institutional DNA of the group and sort of everything in the background is such a unique blend that I think if you speak to anyone in our portfolio, we'll be able to attest to that really, really strongly about how valuable that is.
Oh, look, just as a founder myself, I can tell you that the advisors that you want are the ones who can calmly assist you in circumstances where there's a crisis.
Yeah.
not when everything's going well and everybody's got a view about how the growth strategy should look. Everyone's got those opinions. That's super helpful, perhaps. But what's more helpful is the ebbs and flows of entrepreneurship, which is in every single business, and having people who are prepared to lock arms with you when it ebbs, right? And calmly providing the assistance that you need. I totally agree with that. Eric, did you want to add anything before we move on?
Yeah, I'll probably just add that, when we kind of think about how we engage our portfolio founders and our cadence around that, like one of the reasons why we're a high conviction investor is that it allows us to do less investments, right? And by doing less investment and run more concentrated portfolios, we differ to those that run more diverse portfolios in the sense that we can actually spend a lot more time with our founders and try to add value. And we kind of split the value adding in two phases, which is like when the business is in seed phase, which is when we first invest, to when they kind of like more post Series A or Series B. So typically the second or the third round there onwards from when we make our first investment. During that seed phase or during that initial phase, we are very hands-on in terms of the way we add value. Like we kind of talk about it as like we're a proactive value add investor, meaning that I will meet the founder as many times as I need to, but at least maybe once a month, if not once a fortnight. The idea is we would help the founder any way that they need us help with. And the reality is you have to be flexible, and because every startup is different, like every startup's journey is different. So they're gonna all have different problems. So it could be as simple as actually providing them with first principle guidance to they're looking at doing a hire and kind of giving some advice or even doing an interview for a hire, to even they're doing founder-led sales where they wanted some introductions to potential customers. But definitely across all of them is how do I raise my next round? Where should I go around and raise next round? What should I be positioned like? And can you help me make the introductions, etc. And as these businesses get more mature, what happens is we're helping them stack new investors into the business. We know that we're probably not as better place to add value when the business is a lot more mature, and therefore we almost hand the baton of value adding to new investors. It doesn't mean that we walk away and we don't talk to the business anymore. It just means that we step back as a proactive value investor to a reactive one, where if the founder needs us, we're there, but we're not trying to actively engage them on the kind of regular weekly, fortnightly basis to try to find ways to add value. Because there's probably later stage investors that we've brought on board that's probably more ideal for them. That also allows us to scale and make sure we spend enough time with our portfolio companies at the right stages of their business as well.
Yeah, I love that. That's super important. I'm conscious of time. I want to make sure we've got a couple of minutes for some questions, and I want to give everybody who's on the opportunity to express interest in this in a moment, because we will be prioritising registrations of interest this afternoon and tomorrow in the lead up to this campaign opening officially for investment next Tuesday. There's one more question I want to ask you. Obviously, last night, federal budget was handed down, major changes to capital gains tax, and everybody's concerned about wealth creation, the impact on wealth creation that's resulting from some of those tax changes. But one of the most material tax concessions that's been available to investors in the Australian tax system has not only endured, but it was actually expanded last night, and that's the one that applies to investments in early stage venture capital limited partnerships. For those that aren't familiar with it, it's a federal government program that launched in 2007 and is intentionally and specifically designed to incentivize investment into the venture capital sector through funds that are structured as early stage venture capital limited partnerships. The Aura Venture Fund 3 is that. Eric, do you want to just share with everybody? I can do it, but would you prefer to just share what are the tax concessions that come with an investment in this structure, and why does that matter, do you think?
Yeah, absolutely. So the ESV-CLP structure basically provides our investors a 10% tax offset on the committed capital, and also zero income and capital gains tax from the returns from the fund, right? Which actually provides us with, we're probably the few or only sort of tax, which basically makes venture capital the only asset class that has this like tax alpha in it. compared to other asset classes. It's this morning I was walking around the city and I looked at everyone, and literally everyone's head was between their legs, right? Like everyone was just freaking mopey. Except I was the only one that had a smile on my face.
Yeah.
Because what happened last night basically just enhanced that structural tax advantage for us, or tax.
Exactly.
Because if you kind of run back of the envelope exercise,
yeah,
investors investing in other asset classes will basically have to make 45+% better gains at a gross level to actually get the same net tax outcome than us. And when you kind of have an asset class that is actually very outlier driven and create outlier results, it actually is very, very beneficial over a long period of time, especially with this inflation-driven way of actually applying the replacement of the capital gains discount regime.
Yeah. I mean, you just can't get any better than tax-free. Look, we're gonna end the formal Q&A there. There's a couple of questions coming through. I want to apologise to everybody who's attending. We're not going to get through it all today, but hopefully what you've seen is just how knowledgeable this team is. I love talking to them. We could be here for another hour, but we sadly cannot. Just before we move to Q&A, Jason's going to bring up a poll in a moment, which will give you an indication, give you an opportunity to indicate any interest that you have in the fund, or whether you want to be contacted by somebody to have a conversation about the fund. I should say this though, in terms of process and timing, we've got a limited allocation through the VentureCrowd platform of $1 million. Based on current interest and the level of attendance at this webinar today, we expect that will close very quickly once the campaign opens officially for investment next Tuesday. In terms of process, we'll be prioritising allocations based on the date of your registration of interest. So if you haven't done that yet on the VentureCrowd website, which you can do at any time, please use the poll that Jason's bringing up now to let us know, and we'll get somebody get in contact with you the next day or so to discuss the opportunity. Take advantage of this if you are interested, because I can't guarantee that there will be any oversubscriptions next week. Okay, 2 minutes to go. There is a bunch of questions. Let's do what we can. The first one is from Paul. It's probably quite important. Everybody will have this on their mind. You talked about investing at the early stages. What is the typical first investment size in a startup? And are you sort of targeting certain percentage of equity? What does that framework of the mechanics of investment typically look like?
Go
on. It depends. That's the true answer. Pre-seed deal versus a Series A deal will have a different look and feel, both from ticket size or first check in the door and valuations. Us as an investor, high conviction. I think over the 12 or so years, we've only got 25, 26 positions. So speaking to the high conviction nature, our target ownership is sort of between 12 and 17% on our first check through the door. And the visibility of that investment, we've got at a minimum an observer right or board seats. And then as the rounds mature, both in the fund and through sidecar vehicles, we look to defend our target ownership through pro rata or build on it as we build even further conviction, or potentially an increased conviction around what the team's building as they expand. But the early stage positioning of a pre-seed deal through to a Series A will vary the check size from $500,000 all the way through to $3 million on first check out the door.
Thanks, Mark. Sadly, we're out of time, and I really want to be one of those people that sticks to time, because people have other things to do. So, Jason, I'm going to hand back to you to close. I want to thank everybody for being on the panel, and everybody for attending. Over to you, Jace.
Yeah, thank you, Steve. Thank you again. Thank you to everybody that attended. As mentioned earlier, we are recording this, so tomorrow I will send out an email to you all, and I'll follow up with a text message to let you know that that'll have the recording, and I'll give you a link for the deal page, etc., so you can read the IM, and obviously you can reach out to me directly. And I'll reach out to everybody that has done an EOI or answered yes in the poll. there today. So thank you very much again for coming along. I really appreciate it. We'll end there. Thank you all.
Thanks, everybody.
Thanks, guys.